Welcome to The Explainer. If you've ever stared at a financial chart and just felt like it's a total mess of unpredictable noise, you are definitely not alone. But what if there was a hidden rhythm, a kind of playbook that could help you make sense of all that chaos? Well, today we're breaking down a very specific, rule-based trading strategy known as the ICT Classic Setup. We're going to unpack how it uses the core ideas of time and price to find a potential edge.
For so many of us, staring at a chart can feel like looking at pure, unpredictable chaos, right? You see the price zipping up, down, sideways, and trying to find a consistent, repeatable edge in all that noise, man, it can be incredibly tough, even demoralizing.
But what if it isn't random at all? That's the core idea we're digging into today. We're going to look at a structured method, almost like a secret playbook, that claims to use the market's own internal rhythm to pinpoint some really high probability opportunities.
So let's explore this idea of trading in sync with the market, instead of constantly fighting against it.
This whole strategy really tries to crack the code using two fundamental keys. Now, this is such a powerful way to simplify your entire approach. Instead of getting lost in all the noise, you're just asking two simple questions. First, when should you even be paying attention? This strategy gives you specific windows of opportunity. And second, where on the chart is the critical action most likely to happen? This defines your specific levels to watch. It's all about focusing your energy at the right time and in the right place. And here are those specific time windows. They're called kill zones. A bit of an intense name, I know, but they basically correspond to periods of high volatility and liquidity, usually around the London and New York market opens. Now, according to this strategy, these are the only two times you should be looking to execute a trade. The London session from 2 to 4 a.m. New York time, and the New York session from 9 to 10:30 a.m. So we've got the when lockdown, now let's find the where. And this is where a pretty interesting hidden ingredient comes into play. That secret coordinate is tied to this exact time, 9:42 a.m. New York time. But here's the twist. It's not what happens at 9:42 a.m. today that matters. See, here's the key idea. We're looking at the open price of the 9:42 a.m. candle from the previous trading day. This isn't just some random time pulled out of a hat. The theory is that this specific price level acts like a magnet for price, often pinpointing the high or low for the current day and serving as a super precise entry point. Okay, let's put it all together and actually walk through the step-by-step playbook. But before we get to the full plan, you absolutely need to know about this concept, the Judas swing. Think of it as a fake-out. It's a deceptive move, like a head fake in basketball, designed to trick traders into thinking the market is going one way right before it reverses and makes its real move. And this slide just illustrates brilliantly how it all comes together for a classic sell day. So first, the context is right. The previous day was bullish, setting up a potential reversal. Then, price sweeps the highs and breaks its structure down, confirming weakness. And here's the magic. During the London kill zone, that Judas swing pushes price right back up to our 9:42 a.m. level from yesterday. That confluence, the right time hitting the right price, that's the exact signal to execute the trade. But hey, a plan isn't just about getting in, it's also about managing your risk. In Forex, price movements are often measured in pips. This setup uses a very defined risk with a typical stop loss of 20 pips. That's your safety net if the trade goes against you. And what are we targeting on the other side of that? Well, the objective isn't some tiny little gain, it's often a significant move, with a target of around 100 pips. So when you put that all together, what do you get? You get this really powerful risk-to-reward ratio. By risking 20 pips to potentially make 100, you're looking at a 1-to-5 ratio. And that kind of positive asymmetry is exactly what professional traders are always hunting for. Now, a single trade setup is powerful, for sure. But it's even better when it aligns with the bigger picture. So let's zoom out and see how these daily plays fit into a larger weekly game plan. The whole idea here is that there's a weekly rhythm at play. The high or low for the entire week often forms between Monday and Wednesday, typically during one of those kill zones. So, for example, if your weekly analysis is screaming a bearish week, you'd be on high alert for that classic sell setup to form during Tuesday's London session, because that's a very common time for the weekly high to get put in. And this quote really drives the point home. It's a core principle for this strategy. The daily and weekly charts are the gospel for the week. It just means before you even think about looking for a daily setup, the higher time frame charts should have already given you your directional bias. They've already told you the story for the week. So, What is the key takeaway from all this? What's the actual edge here?
And it all comes down to this one word: confluence. The real power, the true edge of this strategy, comes from that perfect storm. It's not just about time, and it's not just about price. It's about that precise moment when a specific time window, your kill zone, aligns perfectly with a specific, predetermined price level. That is the high probability moment this entire playbook is designed to find.
You know, ultimately, this structured approach is all about transforming trading from reactive guesswork into the proactive execution of a really well-defined plan. It provides a framework for exactly when to act and where to act, leaving you with one final question to consider. Could having a playbook like this fundamentally change how you see the charts?